Florida real estate is your retirement dream? Think again. The dream is collapsing right now. Not gradually, not over years, in real time. December 2025 marks the moment millions of Floridians realize they're trapped in a financial catastrophe that's about to consume their life savings. Behind every palm-lined street and sunset postcard, a darker truth is erupting. Insurance companies are abandoning entire counties. Home values are plummeting 10 to 15%. Families who saved for decades are watching their equity evaporate overnight, while insurance premiums now exceed their mortgage payments. And here's the brutal reality. 2026 isn't a prediction. It's ground zero. It's the year this system implodes completely. According to the latest data from December 2025, Florida's housing market isn't just correcting. It's disintegrating. We're talking about sprawling rural counties where non-renewal rates are the highest in the entire nation. Cities that were touted as real estate gold are now bleeding inventory and hemorrhaging value. The poorest counties around Lake Okeechobee are facing apocalyptic insurance crises that nobody's talking about. Teachers' insurance premiums have jumped 180% in 6 years. Retirees are going without coverage because they literally can't afford it. And entire neighborhoods are seeing for sale signs multiply like wildfire across subdivisions that were supposed to be stable forever. This is where the American dream doesn't just fade. This is where it gets erased completely. If you want the data-driven truth about where housing markets are actually heading, subscribe to Housing Intel right now. Hit that subscribe button because you're about to see markets collapse that the mainstream media won't cover until it's too late. The collapse you're watching unfold in Florida right now represents something economists call a compound catastrophe. 3 separate crises hitting simultaneously: insurance, inventory, insolvency. Pick any one and your market corrects. Pick all 3 and you get what's happening right now across the Sunshine State. Home values declined from their peaks. Insurance costs tripled. And the infrastructure supporting it all is literally failing. 7 Florida insurance companies became insolvent between January 2022 and February 2023. 7. That's not a market correction. That's a structural breakdown. Citizens Property Insurance, the state-backed insurer of last resort, is now holding the riskiest policies in Florida. And here's where it gets terrifying. If a major hurricane hits before Citizens can offload its exposure, the entire state's insurance system collapses. They're not even hiding it anymore. The numbers are catastrophic. The Senate Budget Committee released data in December that proves what Inside Climate News documented. The highest non-renewal rates aren't in wealthy coastal counties like Miami-Dade or Monroe. They're in the poorest inland counties around Lake Okeechobee. Glades County, with a median household income of less than $39,000 a year, has the highest non-renewal rates in the entire state. Hendry, Highlands, Okeechobee. These are the forgotten counties where the crisis is hitting hardest. Insurance companies looked at the risk and decided entire rural communities aren't insurable anymore at any price they're willing to charge. And if you live in one of Florida's 10 cities we're about to reveal, your timeline just accelerated. What you're watching in real time is a phenomenon that started 3 years ago but has now reached escape velocity. It's no longer slowing down. It's speeding up. This is the moment to understand your market. If you're in Florida right now, this next breakdown could save you from making the worst financial decision of your life. Subscribe to Housing Intel and don't miss the next segment where we expose the data nobody wants to acknowledge. Number 10. Port St. Lucie. Port St. Lucie represents a shocking case study in how fast perception can collapse when reality hits. In August of 2025, Local real estate reports hailed Port St. Lucie as the single best real estate market in the entire state of Florida. Best market in FL. Those were the headlines. The reality hitting in December is completely different. What was celebrated as a buyer's paradise 3 months ago is now showing unmistakable signs of severe distress. Active listings exploded to 4,355 properties. Days on market jumped 25.8% year over year. These aren't minor shifts. When days on market surge that sharply, it means the underlying demand collapsed and sellers are panicking. The inventory isn't moving. Properties that should be selling in 30 to 40 days are now sitting for 76 days or longer. That's 2.5 months of a property sitting vacant. 2.5 months of mortgage payments, property taxes, and insurance premiums accumulating while the value of the property continues deteriorating. Builders in Port St. Lucie are already offering massive incentives. $60,000 price cuts, paid closing costs, mortgage rate buy-downs. These aren't competitive offers, these are desperation moves. When builders start cutting that aggressively, it signals they know the bottom isn't in yet. They're racing to offload inventory before prices fall further. And here's what happens when builders capitulate like that. It destroys the comparable sales market for everyone else in the area. Every price reduction ripples outward and pulls down the entire neighborhood's value. Young families who bought in Port St. Lucie in 2022 and 2023, believing they were getting into a market at the beginning of appreciation, are now watching their down payments evaporate. The city marketed itself as affordable paradise. The market realized it was overbuilt on speculation. Now reality is reasserting itself brutally and without mercy. Number 9. Daytona Beach. Daytona Beach occupies a unique position in Florida's real estate breakdown. It's got the beach appeal of coastal markets, but the affordability angle of inland cities. That positioning is now becoming a liability instead of an asset. In June of 2025, 82.1% of all homes sold in Daytona Beach went for less than the asking price. Think about that statistic for a second. 8 out of every 10 homes were marked down before they even sold. The sellers knew the price was wrong before the first buyer even saw the listing. They marked it down anyway, and homes still sat on the market for months. When 82% of homes are selling below asking, that's not a market correction. That's a market surrender. Buyers are showing up and saying no. Sellers are capitulating and dropping prices. Properties are sitting vacant, and meanwhile, property taxes on depreciated values are climbing because the assessed values haven't caught up to reality yet. Families in Daytona Beach are trapped in the worst possible scenario. They're paying property taxes on homes worth significantly less than what they paid. Their mortgage hasn't adjusted downward. Insurance is skyrocketing. And the marketability of their property has evaporated because nobody's buying. The region's economy is heavily dependent on tourism and seasonal residents. When primary residents' demand softens, seasonal demand collapses even faster. Daytona is facing a downstream effect from the broader Florida exodus. As families realize they can't sustain homeownership in the state, they liquidate vacation properties first. Daytona is drowning in inventory from sellers who are bailing out. Number 8. Sebastian. Sebastian tells a story of how quickly equity can evaporate in a depreciating market. The median price in Sebastian dropped from $365,000 to $315,000. That's a 13.7% decline. For a family that put 5% down on a $365,000 property, that's a $13,000 down payment that's already been partially erased. They bought the house and immediately lost money. Sebastian's economy relies heavily on construction trades and service workers. When a construction boom ends and demand softens, those jobs disappear fastest. Builders cut crews, projects get postponed. The wage earners who drove demand out of the market suddenly have unstable employment, right at the moment their financial situation became precarious. Sebastian is a microcosm of how wage volatility compounds with real estate depreciation. Properties sitting 100 days on market in Sebastian represent families trapped in a corner. They need to sell, but they can't sell without losing money, so they hold. They keep paying insurance that's doubled. They keep paying property taxes on a declining asset. And meanwhile, their financial situation deteriorates month by month. By the time they finally accept they need to sell, they've lost even more equity to holding costs. Sebastian isn't a name you hear in national real estate discussions. It doesn't have the brand recognition of Miami or Tampa. But that obscurity is exactly what makes it dangerous. When a market this small starts showing 13% declines, that's a warning that the correction spreading through Florida isn't limited to major metros. It's systemic. It's everywhere. Number 7. Pensacola. Pensacola represents the Panhandle's real estate deterioration, and the numbers are unforgiving. Year-over-year home value growth in Pensacola collapsed to negative 2.2% in 2025. That's a complete reversal from the 1.9% growth in 2024. The market didn't stall. It reversed. After appreciating for 3 consecutive years during the pandemic boom, prices started actively declining. The typical home value peaked at $306,700 in 2024. By June 2025, that peak had flattened and started retreating. Home prices that were climbing now have nowhere to go but down. Price cuts in the metro are still running 29% of all listings. That means 3 out of every 10 homes aren't selling at the asking price. They're marked down, and they're still taking 60 to 67 days to sell. Escambia County, the most populous county in the Pensacola metro, recorded sharp negative 2.5% home value decline year over year. Santa Rosa County, its neighbor, showed negative 1.8% decline. These aren't communities in the midst of a healthy market correction. These are communities facing systematic price erosion. The home price forecast score for Pensacola dropped from 77 in 2021 to 33 in 2025. On a scale where above 55 indicates appreciation and below 45 indicates decline, Pensacola is screaming red warning signals. The forecast is for accelerating depreciation, not stabilization. Pensacola is in free fall, and the velocity is increasing. Number 6. Panama City. Panama City occupies the Panhandle and has an economy heavily dependent on tourism and military installations. Both are showing signs of vulnerability right now. The tourism economy has proven brutally fragile in 2025. Occupancy rates for tourist properties are declining. Vacation home demand is softening as Americans cut discretionary spending. The military installations provide baseline stability, but when you're dependent on single economic drivers, any fluctuation creates massive ripples. Properties in Panama City are experiencing inventory surges matching the rest of the state. Days on market are climbing. Price cuts are becoming standard. The market that was supposed to be stabilized by military payroll is instead revealing how narrow its economic foundation actually is. When you remove tourism demand, what's left isn't sufficient to maintain valuations. Panama City's median income population is being crushed by the same insurance crisis affecting all of Florida. But without the diversified job market of Tampa or Jacksonville, Panama City offers fewer opportunities for residents to absorb cost increases. People working military-adjacent jobs are watching their homes depreciate while their insurance premiums and property taxes climb. The math becomes impossible. Panama City residents are joining the exodus out of Florida. Number 5. Gainesville. Gainesville occupies an interesting position as a university town with built-in demand from student housing and faculty. And that built-in demand is proving completely insufficient to prevent market deterioration. Despite having the University of Florida driving constant demand for housing, Gainesville is still facing price erosion. The city is projected for negative 0.2% growth through 2026. That might sound small. It's not. When you have a university generating constant housing demand and you're still declining, that's not a healthy market. That's a market where supply dramatically exceeds demand, even with institutional anchors. Gainesville's relative affordability compared to other Florida metros is actually accelerating its inventory problems. As other Florida markets appreciate briefly and then crash, some speculators are running to Gainesville hoping for better returns. Instead, they're adding to supply and pushing prices down. Gainesville's market is being flooded by speculative inventory even as natural housing demand proves insufficient to absorb it. Student housing, which should be sticky and reliable, is experiencing higher vacancy rates in 2025. The University of Florida is not the economic engine it once was, relative to the broader Florida economy. Without the traditional demand drivers holding up prices, Gainesville's position as a buyer's market is transforming into a desperate seller's market. Number 4. Jacksonville. Jacksonville represents a shocking reversal. Just 6 months ago, Jacksonville was ranked the 5th best buyer's market in the entire United States. The data from July 2025 positioned it as a stable market with growing inventory and balanced dynamics. The data from December 2025 tells a completely different story. Jacksonville has 9,035 active properties for sale. That's inventory exploding. Homes are taking 63 days to sell, up 21% from 52 days the year before. Pending sales have collapsed. In June 2024, there were 2,500 pending sales across Northeast Florida. In June 2025, that number dropped to 1,700. That's a 31% collapse in actual transactions in just 12 months. The ratio of sellers to buyers has become catastrophic. In Jacksonville, there are now 5 times more sellers than buyers. 5 to 1. That means for every single buyer who shows up in the market, 5 sellers are competing to sell them a house. The negotiating power has shifted so dramatically toward buyers that sellers are already capitulating with major price reductions. Duval County pending sales dropped from 914 in June 2024 to 652 in June 2025. That's 28% fewer homes actually moving through the sales pipeline. Even being ranked as the 5th best buyer's market in the nation isn't insulating Jacksonville from the broader Florida collapse. In fact, it proves that even relatively attractive markets are being overwhelmed by inventory and losing transaction velocity. Jacksonville's median price was $304,130. With prices slightly down year over year and inventory up 13%, the fundamental dynamics are pointing toward accelerating depreciation. Jacksonville went from stable buyer's market to distressed market, showing signs of panic in 6 months. That's how fast this collapse is accelerating. Number 3. Northport. Northport represents the Southwest Florida story of catastrophic equity destruction and forced selling. According to Cotality's July 2025 analysis, Northport is flagged as the 3rd highest risk Florida market for major price decline. Year-over-year price decline shows negative 4.3%. That's not gradual depreciation. That's active value destruction happening right now. Northport experienced one of the steepest price ascents during the pandemic boom. The median price climbed to nearly $480,000 in early 2023. Since then, it's been in active decline. The price chart shows a sharp peak followed by consistent erosion downward. By the time we reach December 2025, prices have retreated significantly, but forecasts suggest we're not at the bottom yet. The city comprises areas like Port Charlotte and Venice, which are known as retirement destinations and second home markets. When second home markets start declining, the liquidation becomes vicious. Primary residence owners are more sticky because they have nowhere to go. Second home owners are looking for exits immediately. Every second home owner who decides to sell becomes an additional property dumped on an already oversupplied market. Northport's real estate agents are watching buyers vanish and inventory explode simultaneously. The market dynamics that worked during the boom are completely inverted now. Properties sitting 100 days are still not moving. When a property marketed to retirees and vacation home buyers sits vacant for over 3 months, the message is clear. The buyer pool has evaporated. Northport is facing sustained, systematic depreciation with no visible bottom on the horizon. Number 2. Miami-Dade County. Miami-Dade represents the collapse of Florida's largest metro, and the numbers are devastating. Median prices in Miami-Dade dropped from $565,000 to $515,000. That's $50,000 of equity destruction. Insurance costs exploded from $3,800 to $13,200 annually for single-family homes. That's a 246% increase in insurance premiums. But the real catastrophe is in the condo market. Condominiums are becoming unsellable financial disasters. Insurance costs for condos are exceeding $20,000 per unit annually in some buildings. Condo owners are facing special assessments for mandatory inspections and repairs. Some buildings have requirements mandating multiple tens of thousands of dollars in repairs before insurance companies will even renew policies. Owners are literally abandoning properties and walking away from their down payments rather than pay these assessments. A Brickell condo owner paying $18,000 annually for building insurance plus $3,800 for personal coverage watched her unit value drop from $420,000 to $365,000. $55,000 of equity evaporated. And then, special assessments for $32,000 were announced. She abandoned a $42,000 down payment and walked away. Teachers in West Kendall earning $54,000 annually are paying $11,800 yearly for property insurance on homes worth $48,000 less than their purchase price. They're underwater, while insurance consumes 22% of gross income before the mortgage payment even enters the calculation. Miami-Dade median income is $78,000. The typical family faces $35,000 in annual housing costs just for insurance and property taxes before touching the mortgage. That's 45% of gross income consumed by housing. Meanwhile, food, utilities, healthcare, childcare, and transportation still need to be funded from the remaining 55%. The mathematics is literally impossible. Families are maxing credit cards. They're depleting emergency savings. They're raiding retirement accounts. And they're doing all of this knowing that 2026 brings another insurance renewal cycle that will push them into foreclosure territory. Miami-Dade represents not just a housing correction. It represents the complete unraveling of housing affordability in Florida's largest economic center. Number 1. Tampa Bay Metro. Tampa Bay Metro is ground zero. This is where the catastrophe reaches its most devastating expression. And the data from December 2025 shows a metro area in complete systemic failure. Median prices crashed from $398,000 to $362,000. 9% correction. Insurance costs exploded from $2,800 to $9,800 annually for average homes. Waterfront properties are hitting $15,000 to $18,000 in annual premiums. The typical family earning $71,000, Tampa's median income, faces $28,000 in annual housing costs, while wages grew just 4% since 2022. Housing costs increased $12,000 annually. Household income grew $2,800. The gap is mathematically impossible to close, and it's accelerating. Nurses at Tampa General earning $75,000 are underwater on mortgages purchased in 2021. A Tampa General ICU nurse who bought in Riverview for $345,000 now owns a home worth $318,000. She's $27,000 underwater. Her insurance costs jumped from $2,600 to $9,200 annually. That's a $6,600 increase that far exceeds any raise she received. A Hillsborough County elementary teacher with 8 years of experience earns $54,000 annually. She pays $8,400 yearly for property insurance on a Brandon home worth $26,000 less than her purchase price. She's underwater by $26,000 while paying 15% of gross income just for insurance before the mortgage payment. Young families who bought with FHA loans in Riverview and Valrico are $45,000 underwater with no equity cushion. When their air conditioning fails, they're forced to finance $8,500 replacements on credit cards at 23% APR because their emergency savings evaporated paying insurance premiums. They're trapped in accelerating debt spirals that push them toward foreclosure every single month. Tampa Bay experienced explosive growth. 45,000 jobs were added in 3 years. But median household income grew just 4%, while housing costs increased 65%. The job growth created nominal employment, but failed to create wage growth sufficient to sustain housing. The jobs being added are service sector and logistics positions. They're not high-wage positions. They're positions paying $35,000 to $55,000 annually, which is completely insufficient to support a housing market that demands $125,000 in household income for sustainable homeownership. Families are burning through retirement accounts. They're maxing credit cards, knowing that 2026 brings another insurance renewal cycle they can't survive. A Hillsborough County family earning $82,000 has already drained $18,000 from 401k accounts to cover insurance premiums. They're calculating that they have maybe 8 more months before forced selling becomes the only option that doesn't lead to foreclosure. Tampa Bay represents the complete convergence of all these crises: insurance, inventory, insolvency, wage stagnation, equity destruction. It's happening simultaneously in Florida's third-largest metro. And the timeline just accelerated into 2026. The ultimate reality hits devastatingly hard. Insurance costs tripled while home values crashed, creating the perfect storm that destroys equity and makes housing unaffordable simultaneously. Families who bought in 2021 and 2022 are underwater on mortgages while bleeding cash reserves to cover insurance premiums that exceed their mortgage payments. When insurance costs $9,000 annually on a median-priced home and values dropped 10%, recent buyers have zero equity and mounting monthly costs they cannot sustain. They're trapped between two impossible choices: keep bleeding money, knowing it ends in foreclosure, or surrender now and lose everything. 2026 isn't a prediction. It's families calculating how long cash reserves last before forced selling becomes the only option. Tax refunds that should fund family vacations are consumed entirely by insurance premiums. Credit cards are maxed, covering basic expenses after housing costs consume 40% of gross income. Emergency funds are drained in 3 months. Retirement accounts are being raided to cover current housing costs, creating a future crisis that compounds the present disaster. This is happening now, and 2026 marks when millions run out of runway. The families making these calculations aren't irresponsible. They're people who saved for down payments, qualified for mortgages, bought in stable neighborhoods, and did everything financial advisors recommend. The system failed them through insurance policies nobody predicted and market corrections that destroyed equity. But here's the brutal truth. The mainstream media is still talking about whether housing will crash. Families in Tampa Bay, Miami-Dade, Jacksonville, and Port St. Lucie already know. They're living the crash right now. 7 insurance companies already collapsed. Citizens Property Insurance is holding policies it can't support if a major hurricane strikes. The entire state's insurance infrastructure is on the verge of complete failure. And when that happens, housing values don't just decline, they implode. Properties become unmortgageable. Forced selling cascades through entire neighborhoods. This isn't speculation. This is structural reality in December 2025. This breakdown could be the difference between protecting yourself from the worst financial decision of your life and losing everything. Subscribe to Housing Intel right now and hit that notification bell. Don't wait. Don't assume it won't happen. Don't tell yourself you still have time. The families in these 10 cities already waited too long. They're making liquidation calculations right now. Be smarter. Subscribe. Watch. Protect yourself. If you found this analysis crucial, drop a comment below and tell us which Florida market shocked you the most. Are you trapped in one of these cities? What's your timeline for selling before the market implodes further? We read every single comment. We'll see you in the next breakdown, where we reveal why California's housing markets are following the exact same collapse pattern. Because what's happening in Florida isn't isolated. It's a preview of coming attractions across every Sunbelt state. The investigation continues. The disasters are spreading. Stay informed. Stay protected. Subscribe to Housing Intel.